Corporation tax is that slice of your business profits that goes to the government. What exactly is it? How is it calculated? And more importantly, what can you do to reduce it? If you're running a company in the UK, understanding these things about corporation tax is essential. My name's Rayhan Mogul. I'm a chartered accountant and the founder of Sidekick Accounting. Over the last few years, I've helped hundreds of business owners in the UK make more money and pay less tax. In this video, I'm going to share everything you need to know about corporation tax, how it works, how to reduce your corporation tax bill, and how to avoid penalties and fines from HMRC. The first question I want to answer is, what is corporation tax? Essentially, it's a tax on the profits of companies and other organizations that are making profit in the UK. This includes limited companies, it includes foreign companies that might have a UK branch, and even places like clubs and associations. Essentially, if you're making money in the UK from business operations, corporation tax is something you're going to have to deal with. Now, before we jump into what you need to know about it, let's cover off what corporation tax is not. Corporation tax is not a tax on your revenue or sales, it's a tax on your profits. So essentially a tax on what's left after you've spent all the money that you need to generate that revenue and run your business. This is a key distinction because understanding this is going to open the door for you to minimize the amount of tax that you pay. So that's what corporation tax is and is not. Next, how much is it? In the UK, since 2023, corporation tax has been set at 25%, but it's not a flat rate for everyone. For companies with profits of £50,000 or less, the tax rate is 19%. For those with £250,000 of profit or more, the tax rate is a flat 25%. But if you fall in the middle, your tax rate is somewhere between 19 and 25%. And that difference is called the marginal rate. In order to get a marginal rate, you claim something called marginal relief. This relief effectively smooths the tax rate between 19 and 25%. So you have a gradual increase rather than a sharp jump from 19 to 25. Let's run through a quick example. If your company earned £100,000 in profit, typically you'd be charged at 25% corporation tax, which is £25,000. Then marginal relief will kick in, which in this case is worth £2,250. So you take that £2,250 of relief off your £25,000 25% tax bill, which leaves you with £22,750. On £100,000, you're paying £22,750, which is an effective tax rate of 22.75%. The calculation of marginal relief isn't that straightforward. So I put a link in the description of this video to a calculator where you can input the amount of profit you're making, and it will then tell you how much marginal relief you can claim. And it will also tell you your effective rate of tax between 19 and 25%. Now that you know how much tax is in the UK, you're probably thinking, I don't fancy handing 25% over to the government. So let's look at what you can do to reduce your tax bill. There are two ways people try to pay less tax. One is completely illegal and results in jail time. The other one is perfectly legal and something every business owner has to consider. The illegal version is called tax evasion. This is where you're purposefully trying to avoid paying tax. The second legal route, which is something we're going to talk about, is tax avoidance. This is where you're applying HMRC's rules in your favor to minimize your tax liability. When it comes to paying less tax, there are three levels. The first is to maximize your deductions. Deductions are essentially expenses that can go through your business. HMRC have issued guidance on what you can and can't put through as an allowable business expense. Having knowledge of this and making sure that you are maximizing everything you can put through is effectively reducing your company profits and therefore reducing the amount of tax you pay. The expenses that go through your business and that are typically tax deductible need to pass the wholly and exclusively test. That means that the expenditure must have been incurred wholly and exclusively for business purposes. So you can't go on holiday and claim that as a business expense, but you can travel for business and claim that as an expense. Other deductions involve things like office supplies, mobile phones, team salaries, and anything else you might spend in the day-to-day running of your business. The more legitimate expenses you can offset against your income, the lower your profits will be and the less tax you'll end up paying. The second level is to plan proactively. This is looking forward to think, what else can I put through the business that helps me to achieve a certain goal? An example of some of these more tactical opportunities could be something like a company car. Putting an electric car through the company will reduce your taxable profit. It will also give you a vehicle that you can drive personally, and it will do all of that extremely tax efficiently. Another option is pensions. Pension contributions from your company are completely tax deductible. So if you are looking to save for your future, you can make pension contributions today, reduce your taxable profit, and get tax benefits benefits within that pension structure. The purpose of this level of tax planning is to ensure that you are using your company in a way that benefits your lifestyle and helps you to build long-term wealth. And the third level is strategic tax planning. This is looking long-term at what it is you're trying to achieve personally and from the business. For example, are you looking to sell the business and move to an island? Are you trying to build a business that you can hand down to your children? Or are you just looking to build it up to a point where it pays you a certain amount per month without many hours needing to go in? Whatever your goal is, having a proper tax strategy in place will help you achieve those things much quicker, much more efficiently, and will leave you with more wealth at the end of it. So what are some examples of strategic tax planning? Well, for example, a business owner that wants to exit their business will need to think about the tax implications of doing that 3 to 4 years out. A strategic tax plan for a business owner looking to exit may involve setting up certain structures so that they qualify for reliefs that mean they pay no tax when they do sell that business. That strategic tax planning that's happened 3 to 4 years out can save them 6 figures in tax. Another example of a strategic tax planning move is looking at tax at an international level. For example, setting up an entity in the UAE to benefit from lower corporation tax rates and potentially lower personal tax rates if that business owner had a goal to leave the UK. There are also a bunch of other strategic tax planning opportunities around trusts, specific pensions, and investment in property that might fit the bill for a certain business owner depending on their long-term goals. So you've made some money, you understand that you need to pay some tax on that money, you know what you can do to minimize your tax liability. What do you do next to let HMRC know that this is how much tax is due? You need to file something called a company tax return or a CT600. This must be filed 12 months after the end of your company financial year. This is different to the tax year, which runs April to April and is specific to your company. You can check on Companies House as to what your company year end is and when your accounts are due, and then count 12 months later for the deadline to file your corporation tax return. Now there's a different deadline to make the payment, which is actually shorter. So you need to pay your corporation tax 9 months and 1 day after the end of your company financial year. For example, if your company year end is December 31st, you'll have 9 months and 1 day to make your corporation tax payment. So that's due by the 1st of October the following year. Have 12 months to actually file your return. So you have until the 31st of December the following year. What happens if you miss these deadlines? If you miss the filing deadline, there's an automatic £100 penalty. Then if you don't file for another 3 months, there's another £100 penalty. If you're 6 months late, HMRC will then estimate how much corporation tax you are due to pay, and they'll charge you a 10% penalty on top. And if you still haven't filed after 12 months, you'll have another penalty of 10% of the tax due. On top of these penalties, you'll also be charged interest if you pay your corporation tax bill late. The best way to avoid these penalties in the first place is to stay organized. Use accounting software to keep track of your bookkeeping, set reminders in your diary for those key deadlines for your company, and hire an accountant if you feel like you just can't keep on top of it all. So that's corporation tax in the UK. Remember, it's not about paying what you're told to pay. It's about understanding the system so you can make it work for you and minimize your tax liability. The most impactful thing you can do to pay less tax is to have a proper tax plan in place. The more you know, the better you'll be prepared to minimize your tax liability and keep more of your money. If you found this video helpful, please like and subscribe for more tax saving tips. If you need help developing a tax plan for your business so you can pay less tax, get in touch with a member of the team using the link in the description.